All right, guys, thank you so much, and welcome to today's big discussion that we've got going here. I want to apologize in advance here for a little bit of confusion. The Zoom system has got both Ben Summers' handsome photo up for both himself and me. So anybody watching this right now, if you see Ben's photo up there, I promise that he is much better looking than I am, but that's okay. Um, Today's discussion is a lot more important than that, and it's really kind of ironically enough, I was joking with Ben about it earlier this week. For guys like us, this is kind of like our Super Bowl. And I see a lot of familiar names on today's call that have seen a lot of the content that we've done and maybe are either active partners with us or in the strategy that Ben promotes and have seen a lot of the content that we produce. And for all of you that have seen some of our previous webinars or discussions that we've had, you know that what's happening right now in the economy and in the world as a whole is something that Ben has been preaching and preparing for literally more than a decade. And I myself, as a real estate investor as well, going back to 2008, 2009, have kind of been preaching some of the principles of some strategies that I believe, and I know Ben believes even stronger than I do, can really protect all of us as individuals, as investors. And that's really the purpose of today's discussion. So this is going to be a little bit unique in the sense that this is much less a presentation or a webinar, and this is much more meant to be an interactive conversation between everyone that's on this call and Benjamin Summers, who's the founder of Adagio Group, and myself, Stephan Piscano. So I want to make it clear from the beginning, any questions, comments, anytime that you wish to speak or even be on camera, please engage with us. That's really the purpose for today. Use the chat box below, and we'll make sure that everyone that wants to speak or everyone that has a question, that you get your questions answered and that we get to have that conversation with you, because I believe that we're in one of the most critical times in our country's history. And for everybody on this call, I know there's probably some of you that lived through the Jimmy Carter days in the early 1980s. Everyone on this call saw what happened 2008 to 2010. We have, our own battle scars, our own wounds from those experiences, but we also have the knowledge, the lessons, and the resources that we've gained as a result of going through those experiences. And so I want everybody to leave the call today, not with any fear or uncertainty, but I want you to leave with a plan. I want you to leave with a set of resources that you didn't have before. And I want you to really feel like Ben and I do, which is some level of excitement about the opportunity that this chaos within the marketplace creates. And again, you can go back to articles I've written. Ben's been featured recently in Forbes and other platforms, podcasts we've done together. This is kind of our wheelhouse. We've been talking about how chaos creates opportunity for years and years and years. So if you're looking for a plan, if you're on this call and you're worried about your 401k, you're worried about rental properties you own, you're worried about your crypto investments, which I would also be in that category with you there too, you came to the right place, because you're going to learn about the strategy that Ben executed during the last crash, 2008, 2009, that outperforms the S&P 500 by, I believe, actually slightly more than 70 basis points. You're going to learn about how you can execute similar strategies right now that will take not only the fear out of the equation for you, hopefully as an investor or just as a human being, but it will get you excited. It'll show you the opportunity and show you how you can profit more in a situation like this than at potentially any other point in your lifetime. So that's what we're going to get into today without my continued rambling there. Oh, one last thing before I bring Ben on and we get into kind of the meat of the backstory and the strategy that we're going to talk about and then engage with you directly. I will tell you, because this is not a webinar, this is not a presentation, this is a conversation with you, you're only going to see, I believe, about 6 to 8 slides today. So this is not by any means the full deck. If you are an investor on this call, you hear the strategy that we're implementing, you'd like to participate as an investor from an LP standpoint, there is the full deck that will be made available to you. If it hasn't already, we can either email that directly or we'll provide a download link either during or after the presentation for you to get access to that as well. So this is really just to give you the content from a broad perspective, answer any questions you have. And like I said, hopefully leave you more informed than you were coming in. So without me rambling at you too much more, I'm going to welcome in Benjamin Summers. Ben, are you with me?
I'm here. Hey, Steph.
How are you doing, my friend?
Getting better by the minute. So, yeah, like Stephan mentioned, the point is to engage in a dialogue, and this is a very abbreviated set of slides. This audience is a little bit different than the ones I would normally speak to, in terms of, generally speaking, when I run presentations, people have already been engaged in my educational content. I know some of you have, but some of you haven't. So I'm going to provide a brief overview about us, take a really 30,000 foot view of the markets, inflationary pressures, what we did to handle the last crisis, the expectation for inflation that we had since 2012 that's finally really manifesting, even though it has been manifest through investment markets for the past decade. And then, how to, again, take advantage of, as Stephan mentioned, the opportunities that these things represent. When you see a crisis situation, that represents step changes in transfers of wealth. And the trick is to be on the right side of that. And more times than not, the right side of that means some level of sophistication. What's that, Stephan?
And Ben, I just to kind of double and triple down on what you just said, and even what I said at the top, to me, and I know to you as well, excuse me, guys, I'll apologize in advance. Believe it or not, I've had COVID twice in the last 6 weeks. So if I cough during the presentation, I apologize. But this is something that we're deeply passionate about from a human being level, right? Because I know for me, investing in real estate like I do, and even just friends, family, partners, investors with me, I've gotten probably 70, 80 texts in the last 2 weeks, and all different levels of wealth, all different political views, and every one of them, it's kind of the same theme, which is fear. And that bothers me because, to reiterate what I said at the top and just really focus in on the dates that I said there, in 2009, your strategy outperforms the S&P by 70 points. And so 2009, I'm not necessarily predicting we're going to see a crash to that extent. It might be worse, actually. It might not. But what I know is we're already in the middle of intense, rapid fluctuation. And that fluctuation is the same thing we saw 08, 09. And that's why what we're talking about so key is because you've been through this. You've seen this story before, and you not only succeeded, you succeeded, correct me if I'm wrong, but I think that was the best percentage returns you've ever generated was during a similar cycle to what we're seeing right now. Am I correct in that?
Yeah, the highest we ever generated was 2009 in aggregate, right? And 2008 was right behind it, and we've done well since. But yeah, that was the peak. And so as you mentioned, there's a great deal of volatility in all markets right now, compounded by marked inflation. Now, the Fed statistics say it's 8.5%. I think anybody with a brain knows that's a blatant lie, right? Like inflation is far closer to 50% than it is to 8. So, and this has been a question that we've been pondering for literally a decade, when the Fed tried to force an artificial recovery post 2008 by printing trillions of dollars. They created an inflationary dynamic, or at least the fundamentals for an inflationary dynamic there. From the Austrian perspective, that is inflation, an increased monetary supply. And then that was doubled down on across 2020. So now you've got, so what's going to win? These titanic inflationary forces, or the lack of economic fundamentals that would lead to a depression or a deflationary environment? And so the answer is, I don't know, and neither do you. So you need to be prepared for both, and that's what I think we've done a pretty good job of doing. Again, since for the last decade, and preparing precisely for this, having seen it on the horizon for quite some time. So I don't normally go ahead.
Oh, just real briefly, before we dive in, and I think you kind of just touched on it, but just to double down, I think one thing that's interesting, because I keep harping on how well you performed in 08, 09, but when we were talking about today's discussion, you told me that you actually enhanced the strategy that you executed in 08 in 2012 to prepare for what you believed was coming as a result of the additional trillions and trillions of dollars that was printed and this possibility that we're seeing right now. So this is literally what you prepared for with that enhancement. Can you just briefly touch on that? Or maybe I'm jumping the gun. If I am, I apologize. But can
No,
you
no,
talk on
no,
that
no.
from a broad level?
Now's
Yeah.
as good a time as any to talk about it. So, yeah, it's not a possibility. It was an inevitability. I mean, Ron Paul beat the drum in 2008 and 2012, and nobody listened, right? Or at least, and the people who did
Yeah.
were sort of muted. Um, so the fundamentals have been there for a long time, and we've seen the expression of inflation in asset prices, particularly the stock market, right? And then by extension, real estate, because what happened was, as a result of all of the money printing, the smart money saw that, okay, the equities markets are now just riding the Fed. The stock market is not priced based upon fundamentals. It's priced based upon monetary policy. And then you saw, particularly in 2012, groups like Blackstone just throw billions of dollars into the real estate market, making it an extension of a traditional and just another traditional asset, effectively. So now, so you saw this run up in prices across everything for the past decade. That was inflation in no uncertain terms. But then the money became available to the public in 2020 with all the stimulus checks. And now the inflation is pervasive and inescapable, right? I mean, it's at the grocery store, it's at the pump. And so anyway, but at the same time, as you know, I mean, kind of similar to the 70s in some respect. The fundamentals that support a strong economy, a strong middle class, just really are not there, and that's huge. So what happens, right? Do you face a potential recession, or do you face recession or inflation? And the Fed has backed itself into a corner. Now, the Fed itself has been insolvent on a mark-to-market basis for 5 years, and that only gets worse and worse and worse and worse. The Fed shot its load in 2008. It doesn't have any more dry powder. So there's a 75-point basis hike yesterday to the Fed funds rate, and it's going to have a marked value, or it was already priced in effectively. But you can see how the equities markets have responded to the Fed guidance that interest rates are going to go up. The markets are fall, and if the Fed does what it has to do to begin to arrest inflation, then it's going to cause at least a temporary depression. Again, we have a precedent for this. Paul Volcker hiked the Fed funds rate to 21% in 1981,
Yep.
right? And that was in response to us removing the gold backing from the dollar. We told the world that they could no longer redeem gold with their dollars, and so that was the only recourse we had to preserve the reserve status of the U.S. currency. But now we can't do that, because if the Fed hikes interest rates substantially more, then it will bankrupt every institution that holds long-term debt, because they bought that debt at low interest rates. So if the bond math is inverse, so if interest rates are pushed up very high, then all the entire banking system that's holding debt with low yields gets bankrupted. It can't do that. So and the question is, how do you sort of navigate this stuff? So again, before we go into anything else, should we open the floor to questions and discussion points around that?
Well, I was just thinking the same thing, because I just had like 6 questions pop in, and I'm like, and I better shut up because we'll never get into the slides if I do. But yeah, just a reminder, guys, you're here not just to listen. We need you to engage. We want you to engage. So I need to see more activity on the chat box if you can, because your information, your insights, just as valuable as ours. So anybody that has a question or a comment, if you could type that in the chat box there for us now, or if you have any questions that you'd like to speak on, then raise your hand right now, and we'll go ahead and go around to kick things off. And please don't hesitate, otherwise I'll start calling on people, and nobody ever likes that. So anyhow,
all right.
But
so while people are sort of finding their bearings there, I guess we can just start to dive into to the content. Yeah.
Yes, sir. Let's do it.
Okay. So again, I normally don't run discussions in this format, but I felt because some of the audience is not familiar with me, that there's some need to introduce myself. So anyway, I'm Ben Summers, as Stephan introduced in the outset. I run Adagio Group. We're a boutique investment bank. I didn't come through a traditional path. My academic background is in physics, so I'm a numbers guy. I cut my teeth. I was in oil and gas globally, and then migrated to real estate, and then quickly progressed into finance. My academic background in math allowed me to readily take on quantitative work and use those mathematical skills again to conduct financial engineering and navigate and create and maximize investments and investment portfolios. So that was first really expressed and tested in 2008, as Stephan mentioned. So I left West Africa, running infrastructure development over there for Shell and National Oil of Arco in 2005, and started Adagio LLC. That was a single entity real estate investment company. Saw very quickly that there were a lot of people chasing very few good deals. There were these people called hard money lenders that had just a magnificent position in the market, but that required a lot of money to execute. So we need to raise money to execute this lending strategy. That's the business of finance, and that's when I dove into really learning the finance principles that allowed me to apply the math in a meaningful way. So began running a real estate ABL strategy, ultimately through Adagio ABL LLC. Then we progressed into providing capitalization services for other asset managers, which was sort of the proto investment banking model, and have continued to grow and expand what we do since then. The key sort of takeaway from that experience that I was shocked to realize that I know everyone can benefit from if they've got the sort of the patience and the intellectual curiosity to pursue it, is that in investing, there are only three variables that matter: risk, return, and liquidity. And all three of those are numbers. Risk can be measured. Now, I wrote the book on the subject. We talked about it in my podcast. I'm not going to belabor the point here. But
I don't want to cut you off then, but just because you mentioned it, I did just post episode 1 of the podcast in the chat box for anybody. Obviously, you wouldn't want to listen to it right now, but anybody that wants to check that out and hear more about Ben's personal evolution and backstory, that's a great episode to listen to, in my opinion, because you've got a pretty unique background, my friend, that brought you to the point to where you're at. So anybody that has more interest in kind of hearing the longer form version of Ben's background, that would be a great thing to check out. And then, of course, like and subscribe. As they say. So anyhow, I'll shut up.
Yep. No, I appreciate that. Certainly, but that will round out the story for those who are interested. So this is a brief timeline of the evolution of Adagio Group, and we are a quant-based boutique investment bank that capitalizes best-in-class alternative asset managers. And so Stephan was talking about our performance in 2008. This is the performance of our strategy in aggregate across entities. And as Stephan pointed out, when the S&P was down 37 points, not basis points, but full points in 2008,
yeah.
we were up 32%. That's like, we were up 32%. And the column to the left, for those who have the interest, are the mathematical measures, the risk-adjusted performance measures for our strategy as compared to the markets. And you'll see even after 2008, our performance came down a little bit, but it never dipped below 20%. And people in uh, public markets and liquid markets think this is not possible. And my response is it is not within public markets, but that is no fault of the traders. That's a function of the markets, which are efficient. So, again, I talk about this a lot in other places, but the point is this: it is true that now real estate is liable to fall into deflation or recess, just like any other investment market. It just does it a little bit more slowly. And so if you compare the performance of the real estate, the national real estate market as a whole, to the S&P as a whole, you'll see that there's not a whole lot of difference. I mean, here, if you look through, for the 14-year period from 2007 through 2020, the expected return of the FTSE Nareit index is about 5.8%, while the S&P generated 8.8. So, I mean, the S&P is even better than real estate as a market. So what makes real estate so attractive? And the answer is this: inefficiencies. What that means is the amount of resources, expertise, money, time, and energy that goes into trying to find a quote unquote good deal in the stock market is almost infinite. Every institution, the most sophisticated people in the world, are applying the highest level of resources in the world to beating the S&P with stock trading. Real estate, on the other hand, is very, very inefficient. What that means is money doesn't flow equally to every listing. Information doesn't get out, right? So if you've got a probate sale, not everyone knows about that. There are the seller's circumstances that make them inclined to sell on favorable terms are impossible to know unless you actually go on the ground and begin sourcing these opportunities one by one and negotiating individual deals. So what that means is you can find holes in the market because of inefficiencies in capital flows, inefficiencies in information flows. There are exceptions to the market. This is highlighted, and the sort of the avatar for this, the personification of this, is wholesaling in real estate. People are finding properties at effectively a 30% discount to market. If you can buy something at a price that is less than the actual market value, that is a hole in the market. That's impossible in stocks. Price and value are always equal in the stock market.
Imagine if you were going to buy when Apple's, or not Apple, well, let's just say it was Apple because it doesn't really matter. When Apple was at $2,000 a share before they did the split, if you could find a way to buy it for $1,400, right? So, I mean, then you've got an instant profit. It's just not feasible.
It doesn't exist, right? Because if there's any discount at all, the algorithms find it and they buy it, right? It's just not, that can't happen in real estate. So a lot of people get into this argument: what's better, stocks or real estate as a market? And I'll tell you, they're both shit, right? It's not the market that makes the opportunity. It's the individual asset manager, the trader. And so now if we start looking at the trader and the trader's individual strategy, now we have something to compare. And if the real estate asset manager has a strategy that is able to take advantage of holes in the real estate market, then he will do very, very well. He will do impossibly well from the perspective of the stock trader, because there's no such thing as a hole in the stock market, because everybody sees it. Everybody sees the pricing. And so price and value are almost by definition equal in the equities market. So again, I hope that makes sense, that it's the inefficiencies in real estate that allow individual asset managers the opportunity to do grassroots labor to find and mine holes in the market. And those holes in the market are what generate the opportunity. And then I see, it looks like Leon Brown asked a question. So I've actually got the next thing I'm going to talk about kind of relates to that. And now you can apply financial engineering skills that real estate people typically know nothing about to real estate, and all of a sudden now you can hit it out of the park. And one example of
Well,
that is options. Go ahead,
oh,
Steph.
sorry, Ben. Well, just two quick things, just because I feel like you're kind of hitting on my personal theme of the day with what you're saying. You're talking about, you're calling it inefficiency, but to me, what you're saying radiates the same general thought process as what we're talking about, what's going on in the world and in the financial markets right now, which is that chaos creates opportunity. You can call it chaos, inefficient, whatever it may be. But one of my favorite sayings is, the biggest difference between prosperity and poverty is access to information and opportunity. And what you're basically saying is because of the fundamentals that you have in place, the access that you have in place that you can now share with everybody potentially on this call, it gives you access to opportunities that simply don't exist in the mainstream investment cycles, in the stock market, in the equities world, and really don't exist for everybody in the real estate sector either, because many people just don't get to know that these opportunities even exist.
Yeah. So
Yeah.
yeah, you are. Yeah. And so for those who don't know, efficient markets is a specific term within modern portfolio theory, and it has a specific definition. An efficient market means that everybody has the same access to information to make an informed decision, right? And that's provided through the public reporting. That's a requirement for all publicly traded companies. So everything that is germane to the pricing is public record and relatively easily accessible. So that there's no like, oh, insider trading. I mean, that's what insider trading is. It's somebody who has inside information somebody else doesn't have that gives them an advantage in trading. Well, there's no such, it's impossible for that to exist in real estate. It's impossible for everybody to know everything there is to know about every property that informs its potential price of acquisition, right? Because again, idiosyncratic considerations. Somebody might be in probate, somebody might be dying, there might be a divorce that has urgency. And you can't know that stuff until you engage a seller on a one-on-one basis. And it's impossible for any sort of central hub of data to capture all of that. So that's what's meant by efficient markets. It's that everybody has access to all the same information to make an informed decision, right? And then capital flows also are inefficient, which means that efficient capital flows means that they should flow to the best value within a market. Well, that doesn't always happen because access to capital in real estate is not equal. Blackstone can do a lot more than, say, mom and pop investor can. Blackstone has access to like a Deutsche line of credit at effectively no interest that mom and pop can't get. So access to capital is another form of inefficiency that affects how things are priced and valued. So anyway, I don't want to go into a lecture on modern portfolio theory because in general, I don't agree with much of it, but there are some principles, some foundational ideas that sort of inform all of this stuff. A lot of these metrics come from modern portfolio theory, although I do not necessarily agree with the conclusions that most modern portfolio theory subscribers would draw. So anyway, long story short, we did well, and we did well because we were able to take advantage of inefficiencies in the real estate market using options and inefficiencies in capital flows. Because there are people who are investors who had done the work to go find the good deals, but they couldn't get access to capital. We were the only access to capital. So now we were able to leverage their work to find the diamonds in the rough, the holes in the market. And then we were able to finance them because we took a unique perspective, valuing the property in a meaningful way, as opposed to relying on the sheep, the banking industry's perspective on how to value a property based on comparable sales. And I'll talk about that, I guess, now, which is, okay, you made good, you did really, really well for a long time, but how? Prove it, right? So this is what we did.
Yep.
And it starts with looking at how to responsibly value a property. So in the stock market, there's something called a PE ratio, a price to earnings ratio. And now it's really out the fucking window. But it used to be about 16%.
It sure is. Yeah.
I mean, 16x, right? Where you didn't want to buy a stock that was valued 16 times greater than its earnings. And so if you take that same principle and apply it to real estate, that means you want to look at its income compared to its comparable sales value. So the analogy for for price to earnings ratio in the residential market would be the gross rent multiplier, and in the commercial market would be cap rate. Now, the math isn't exactly the same, but it's the same idea. It's a comparison between income, either net or gross, to value. And so in the early, like mid 2000s, when I first started out, I saw that if you looked at, so the government's shit at everything except collecting data. And what they did a good job of collecting the historical rent data. It's under the BLS's owner equivalent rent metric, and then the U.S. housing price index, which looks at the change in home value of a single property over time. So it's a really accurate measure of comparable sales value. And so what we saw is that, not surprisingly, when the Fed injected itself in the market in 2000 to inflate the dot-com bubble, comparable sales values took off because there was effectively free money for real estate buyers to borrow. And so they did. So people bought. But the rental market really didn't change much, so it stayed the same. And you saw that the comparable sales values, which is this blue line, was in a bubble running away from the rent. And so if you take this chart back, or a proxy to this chart back to the 1920s, you'll see that rent and comparable sales value tracked 1-for-1 for almost a century. And it wasn't until 2000 they started to diverge. Yep, go ahead.
And I'm sorry to interrupt, but this is one that I can kind of talk in depth about too, because this is a period in my life as a real estate guy. I made higher percentage returns from 2009 to 2012 than any other period in my career as a real estate investor, because of exactly what you just said. You had all of the foreclosures, former homeowners now influxing into the rental market, so now there's more renters there. And I actually hadn't researched it to the extent that you have here, but the stats I had back then, where I was located at the time in California, price values of real estate dropped by 70, 80%, and rental rates went up about 2 to 6%, depending on the area. And for me, and I know, and you do it on a much broader spectrum and a more in-depth way too, but it's the same general principle. I was ecstatic, and I'm ecstatic right now because I see potential. To be clear, I guess we should both give the disclaimer: never ecstatic for anybody to be foreclosed on, lose their home, and obviously what's happening in the economy is terrible. And so empathy for anyone that goes through that. And that's the purpose of calls like this, is so that people don't have to go through the heartbreak that this kind of thing can create. But as an investor standpoint, purely from that, if you're generating a 20% cash on cash return on a rental property, and then the market crashes and the house that you bought is now worth half that you paid for it, I'm ecstatic because now I can go buy one just like it, and I'm getting a 40% cash on cash return because rental values largely remain the same. And I guess that leads me to kind of my long-winded question I want to ask, Ben, is going back to your previous slide, we look at how well you performed during the last crash. And like you said, it's been consistently above 20% every year that you've been doing this. But you do a little bit better. You can see if you look at the peaks there, you're doing a lot better in times of chaos. So is that one of the fundamental reasons, and I don't know the answer to this, but is that one of the reasons that you do better in times where the markets are doing worse, is because you piggyback off of the consistency of cash flow versus the volatility of hard assets like real estate or any asset for that matter?
Well, it was two things. So going back to this chart, number one is that in 2006 and 2007, when I was getting pressured by the idiot realtor crowd, when I was like, look, I'm gonna look, all right, what's the highest historical cap rate, or the lowest historical gross rent multiplier for this neighborhood or for this apartment building? That is that's all I'm willing to pay. So what's the current rent, right? And given the current rent, gross or net, whatever we're looking at, right? And the highest historical cap rate or the lowest GRM, that is all I was willing to pay. And the realtors were like, well, it's worth more than that, right? I said, nope, I'm going to do it. And so that's when we, again, became the lender. And so you can't say, and so at that time we're willing to buy at like a 50 or 60%, or 40 to 50% discount to value. Nobody's going to sell at a 40% discount to value at scale, but you can lend at 50 to 60%, and people eat that shit up all day long, especially if you have a second mortgage to bridge the gap, right? Which you can relatively easily do. And so the reason we did so well, particularly in 2009, is because we were the only show in town with money. Like there were a shit
Yeah.
ton of good deals with people who were looking to buy up, sort of the distressed assets, and nobody was lending. And because we were conservative in 2007, and we didn't lose anything because we saw what the bottom value was going to be, we were still liquid to lend in 2009, 2010. So we that's where it came from. That's where it came from. It's an example of inefficiencies in capital flows. We were the only access to capital that a lot of these investors had. And so that's why. And the reason our returns actually came down since then, when everybody else was doing really well in the S&P, is because the markets became relatively flush. They became flush with cash. And so you got B2R Finance, was a division of Blackstone out of North Carolina.
We did Oh, sorry.
Yeah.
No, we did a marketing campaign for Tim Harrigan then years ago. Yeah, and it was anyhow. But
so there's an influx. There's an influx of money, and we were still able to do well because all of their underwriting was still shit, right? They were all still just underwriting from the same Kool-Aid bucket. So there was always an opportunity for us to pick up the borrowers who didn't meet the qualifying criteria from these quote unquote asset-based lenders, hard money lenders, because they were still kind of matrix lenders. They still wanted FICO, they still wanted personal guarantees, they still had a prepayment penalty and all this shit. And so we could beat them on that. But it wasn't nearly like it was in 2009 when there was nobody with money. So that's why. Go ahead.
Oh, sorry. Well, I apologize. You just get me excited, but that's why I love working with you and investing with you and sharing what you do with my network as well, is because a rising tide floats all boats. It reminds me, I bought my first house when I was, in my early 20s during the last peak. And I remember the agent telling me, because I told him, like, I can't afford this house, right? And he's like, well, don't worry about it, because you're going to be gaining $10,000 a month in equity. I was like, oh, okay. So back then in 03 to 06, you didn't have to have any skill. You didn't have to have any oversight or talent or whatever. Rising tide floats all boats. But I want to work with people that have the fundamentals to where they're succeeding when everyone else isn't. And that's what your track record's proven. So I actually even like the fact that you're about even with the S&P during these idiotic cycles where everybody's making money. Because, okay, cool. That's fine. There's no talent. There's no skill to that. And it's funny you brought up B2R, and I don't want to say anything negative about them because I like Tim. I don't think he's with them anymore. He's a real good guy, and I met some people there, nice people. But having worked with them on the marketing side for a couple of years, I can tell you my guess is they're probably not doing too well today because they're lending. They were telling me they pretty much wanted to lend to anything up to 80%. Their oversight was nothing. So to have the diversity and the oversight that you've had for going on almost 20 years now, and going back to how well you did 08, 09, where you only had a few years of prep in this type of a market cycle, and it was unseen territory. I'd imagine now having 15 years plus to prep for something like this, that you're more primed than you've ever been for what's coming.
Yeah. Like we started off the conversation. Yeah, like we started off the conversation with, right? Like, fuck, I was prepared in 2008. I'm certainly prepared now, right? And I've been expecting really bad inflation for right at a decade, right? It was 2012 when QE really hit the ground, and just it never let up, right? So I mean, I wrote a white paper on that in 2012. It's the prologue to my book now, right? So like, this is well-treaded territory. So yeah, that's that. And I guess to finally put a point on Leon's question, options, again, I talk about it in a lot of the stuff I've written, the book, masterclass, like the white papers. Options in general provide a great
But Ben,
opportunity, but yeah, go ahead.
I apologize. I'll just read Leon's question real quick here, just so
Yeah.
everybody else can hear and tie the two together. I apologize I didn't do that already, Leon, as well, and thank you for engaging with that. So just so everybody to tee this up, Leon said, "How can you use real estate derivatives to create a positive alpha right now?"
Yeah. So options in general are great, at least theoretically, for this reason. I'm not going to go into a dissertation on risk analytics, but long story short is if you buy an option, don't sell one, don't write one, but if you buy an option, then you have a very limited downside, just the option fee, and you have potentially infinite upside. And that's called positive convexity. That's positive skewness, third order risk measure. And so what it does is if you buy an option, even if you bet wrong, even if the market does exactly the opposite of what you think it's going to do, your losses are very, very small relative to what the upside would be. So let's just take $1 million house, right? If I think, let's say I think there's going to be inflation, I'm going to buy $1 million house today because I think it's going to double in value because of inflationary pressures. So I can buy a house for $1 million today, and then maybe inflation takes hold even worse than it is now, and it's worth $2 million in a year, which is not incredible because that's happening in Florida for the past year. So great. But what happens if the market tanks and that thing loses 75% of its value, which we saw happen in 2008 in a bad deflationary spell. So you could lose potentially up to $1 million, probably not, but you could easily lose 500,000, and it's not unreasonable. You lose 750,000, right? Now, what happens if you take that $1 million property and you say, I'm going to put an option on it for $10,000. I'll give you $10,000 today for the right to buy it for $1 million over the next 12 months. Well, if the house appreciates, you get the exact same appreciation that's yours, right? As if you paid for the full price of the house with a straight acquisition. So you can still make, whatever, if it doubles in value, you still make $1 million on it. But now you made $1 million on a $10,000 bet via an option fee. And if it goes down, if it loses value, then what do you lose? You lose 10 grand. You don't lose 500,000. You don't lose 750,000. You lose the option fee. Now it's a little bit harder, I think, now, maybe to buy an option for on $1 million property for 10 grand. But I did it all the time in 2008 to 2012, right? And you can still do it today. But the point is, you'll never have to write $500,000 for an option, right? And again, and information's inefficient. A lot in public markets, everybody knows how to price an option, and so they are efficiently priced, and you're going to pay. But in real estate, no one knows how to price an option. So there's plenty of opportunity to find many holes for people who are willing to say, "Hey, yeah, sure. If you give me 10 grand today, I'll give you the right to buy my property over the next year." Plenty of opportunities, and that's an example. Right? That makes sense.
Well, and what I love about that, Ben, is you're not making yourself a slave to the market, is what I like to say, into appreciation. You're giving you're constantly maintaining control and flexibility to go wherever the market goes. And I just know, I always tell everybody, I joke about it, said it to his face probably, 6,000 times, but I only understand about 40% of what Ben says. But this fundamental core philosophy to me is something that even I have always been a fan of, because nobody really ever knows exactly what a market's going to do. Nobody knows what Bitcoin's going to be worth a year from now. Nobody knows where the real estate market goes. Certainly you don't know where the stock market's going to go. So all you can do is base your strategy fundamentals on cash flow, which we talked about in the last slide there, which gives you more stability than anything else you can do. And then to be able to still capitalize on some of the equity upside and downside, this option strategy, it gives you total control, regardless if the market drops, then you can renegotiate. If the market shoots up, then you're protected and you get to cash in. So I think you've protected yourself from every angle about as well as you can here, in my personal opinion.
Yeah. I mean, if you can utilize an option in lieu of a straight acquisition, Generally speaking, I always take that option. I always go down the option path if you can, right? Now you can't always, right? There can be situations where you can't always buy an option. You had to, maybe just pay the piper, and sometimes that may be worth it. But in general, an option is a way better play than a straight acquisition of anything.
Well, would you
So
agree too, Ben? Even if you're going to go down that route and you have to do the acquisition, that's never your core philosophy, right? You're never buying a property and say, hey, you know what? I'm buying this because I think it's going to be worth 20% more in
never.
2 years. Right? Yeah. So
never. So that goes back to risk analytics, right? And this is where real estate people really just kind of fail in general, because everybody in real estate, with very few exceptions, put on rose-colored glasses and like to sell people on their market predictions. Everything in real estate is sold off of a fucking pro forma. And nope, and real estate people are the least qualified to draw up a fucking pro forma. So the way the way that you evaluate the quality of an asset is not by looking forward, it's by looking backward across a market cycle. So if you want to buy an apartment building, don't tell me what you think it's going to do in 10 years. Show me what it did for the last 10 years, or actually in this case, last 15 years, right? How did it perform across 2008, right? Now we've got some information that we can make decisions based upon. So you look backwards in time, don't look forward in time. And that's why finance people generally don't take real estate people seriously, because it's always that pro forma shit with rose-colored glasses. So anyway,
hey, Ben,
and that's how we go ahead.
Well, to kind of briefly touch on that, because I think it's relevant to what, one of the core things we're talking about here today is, so if someone on this call wanted to actually invest with us, with you, in the strategy that you've implemented the last 15 plus years here, correct me if I'm wrong, but my understanding is, because obviously we're talking a lot about real estate today, which is great, and I know that's an interest of mine and a lot of people on this call, but that's just one of many asset classes that I think you've always used the term, you're asset class agnostic, to where you're going to kind of keep that flexibility to go wherever the upside is in any given market. But every strategy, every investment, every fund or group, whatever you want to call it, that your fund, your investment bank invests in, has to go through your risk analytics process, which is pretty proprietary and I think recognized in the industry is, in my opinion, among the best or the best, before they'll be accepted, right? You have to put them through a pretty rigorous cycle to see how did you perform over the last 15, 20 years, right?
Yeah, so a couple of points about that. Number one, I'm not doing myself any favors by talking about real estate. It's one thing, like people have a hard time holding two thoughts in their brain at the same time, right? And so like, oh, you start out in real estate, so you must be a real estate guy. No, goddamn it, I'm not a real estate guy. We're an investment bank, we're asset class agnostic, right? So that's number one. And what that means is, yes, we will still run this ABL strategy. We don't run it. I don't run it with my hands on in the same way I used to. We effectively, for lack of a better term, you can think of it kind of like franchising it, right? But it's the same strategy, and for anybody who that we work with that utilizes it, we make sure that they don't violate the principles that we prescribe. But the point is that as an investment bank, what we do is we say, all right, what asset managers are able to generate the best performance? We don't care if they're real estate, private equity, hedge funds, don't care. And the next question is, well, how do you determine what's good and what's not? And that's where risk analytics comes in. And so there is one proprietary piece to what we do, and that's the SAR rating, the Summers Alternative Risk Rating. But that's just a composite of well-established risk-adjusted performance metrics. I did not invent quantitative finance. It has been an academic discipline that's fairly well established for over 70 years, right? The problem is it generally never leaves the gates of academia, and certainly doesn't leave the gates of the sort of the back offices of the big wirehouses, because that is the information that the financial firms use to effectively bet against the public. They're happy with you making decisions off of fucking pro formas. They want you to, right? Meanwhile, they know how to engineer and structure investments that will perform with some level of reliability, so the house always wins because they know the rules of the house. It's not as simple as a casino, but the principles are the same. So when we're underwriting an asset manager, we use the same quantitative metrics. And what does that mean? It means we look at their historical performance across a minimum of one complete market cycle. And then we evaluate them by taking into account all four statistical moments of risk. I talked about the third one, skewness, already, which is how does the upside compare to the downside? The first one is mean. That's the expected return. You just average the historical returns. That's what you expect. The second one is variance, standard deviation. How much does it move up and down? Third one, it's like I said, a skewness, upside versus downside. And then the fourth is kurtosis, which is the very low probability events, the fat and the tails, right? How fat are those tails? So how often do these low frequency events actually occur, and how detrimental are they, right? So for example, 2008 happens once a millennia or less, and the effects, the banking industry lost more money in 2008 than it had in the previous 2,000 years of banking. So that is a huge kurtosis issue that can be measured if, to the extent you have data to look at. So the good news is that 2008 told us just about everything that history can tell us about what a bottom looks like. Now, as Nassim Taleb talks about, can a black swan event occur? Can something in the future happen that has never happened before? Of course. Can you prepare for that? No, by definition. But if you prepare for the worst case scenario you've ever seen, you're going to do way better on a relative basis than everybody else. You still
and that's
have
all you
sort
can
of,
do. Yeah.
that's right. Yeah. And again, like you don't have to outrun the bear. You just got to outrun your friend, right? So even if an event occurs that is unplanned or unexpected, and it's never happened before, because we've engineered everything we do to be robust against another 2008, it's still going to do exponentially better than everything else, right? So the point is to accurately evaluate the quality of an investment portfolio, strategy, or otherwise. You conduct a statistical analysis of its historical performance across a minimum of one complete market cycle. And the result is numbers. And those numbers allow you to compare anything apples to apples. You can compare a whole portfolio to an individual asset. You can compare stock to real estate to a bottle of wine, a hedge fund to private equity. You can compare absolutely anything to anything when you understand quantitative risk analytics, which it's NYU frames it as the rocket science of finance. I guess it kind of is. But it's where all of the meaningful information about an investment can be found. And it's the only place meaningful information about investment can be found. And that's what we use to evaluate asset managers that we capitalize through our platform. And so this ABL strategy was my proprietary strategy. It's the first thing I ran. But today we work with quants in the hedge fund space, again, private equity. We're asset class agnostic. So yeah, I hope that answered the question.
Well, and Ben made me think here, and this may be redundant, but I haven't ever actually personally offline or on a webinar or podcast, I've never actually asked you this, but with everything going on right now, and we touched a little bit on the backstory of the strategy and the success that you've had going back to before '08, during, after, and currently. With the market being what it is, to where you've got the stock market crashing, you've got crypto just tanking, you've got real estate with, I'm talking to sellers that are just terrified and either dropping prices dramatically or, and then I'm talking to buyers that don't want to make offers because they want to see where this is going to go. And yet, again, as I said at the top, I'm excited about the opportunity presents as an investor. How do you feel right now about where the market is, and how optimistic are you about the strategy being able to perform in 2022, 2023, 2024, similar or better to it has in the past, and to you have in the past?
So yeah, I think that harkens back to what I began to say originally, which is I honestly don't know what's going to happen in the future. I've got a guess. I kind of expect that we're going to have a transient recession that's going to be punctuated by rampant inflation. Think Weimar Germany. The fundamentals are there. But the fundamentals for rampant inflation have been in place since 1971. We are 50 fucking 1 years later, right? And the house of cards is still standing. So I don't know what's going to happen or when, but I do know that when I'm underwriting an asset manager, if I'm designing my own strategy or refining it, I'm doing it with an eye on both eventualities. It has to be robust against both the recessionary and inflationary dynamic. So again, can circumstances arise that break the boundary conditions that we have designed our strategies to perform? Absolutely, it can. But if our boundary conditions are broken, then everybody else's are completely blown out of the water. So
then we got bigger problems, and we're probably all hoarding guns in some hut somewhere, getting ready for World War III.
We're all trying to plant food in Montana or something. But
yeah, something. Yeah.
But yeah, like the point is that I've already survived and thrived across a depression. And 2008 was a depression in no uncertain terms. And I have been acutely preparing for inflation since 2012 simultaneously. So nothing is going to surprise me. And instead of coming across as some pretentious asshole who's has a crystal ball and is going to predict the future, it cannot be done. Anybody who says that they can is a con artist. And the only solution is to design a future that is robust against every eventuality.
Yeah.
And I think we've done that as well. Yeah, and I think we've done that as well as anybody because we are in private markets predominantly. So if it's not real estate, it's in private equity or small business or merchant cash advance, whatever. So there are arbitrage opportunities there. And we make sure that if there's inflation, that we capture that. And that if there's a terrible downside, we know what that looked like in 2008, and we won't be affected if that happens again. So we have designed. Yeah. So I mean, and the smartest guys in equities, stock traders, hedge fund guys, they can be aware of these pressures, but there's nothing they can do to mitigate them because they're stuck in efficient publicly traded markets. There's nothing you can't do anything about that.
That's exactly where I was just going, Ben. It's funny because I was just, and we've got one of our mutual partners and fund managers, Jeff Williams, on with us, who was with Goldman Sachs for I believe about 10 years or so. And there's Carl Moore, who works with you as the fund manager, who's got that background as well, and the financial, with a lot of people that are either investors or partners that have kind of been in that world and saw this stuff, and in some cases even kind of sounded the whistle from the rooftops. Hey, let's do something in 2008, 2009, and they weren't able to. And like you said, I'm really happy and thankful to hear that you said that the way you did, because nobody knows what's going to happen. All you can do is be as prepared as possible for any outcome. And it's shocking how many of the big boys on Wall Street either don't think about this stuff or they're not able to execute on the proper strategies to protect themselves because of the infrastructure that's in place and the protocol they have to go through, where you have more flexibility, right, to be able to take
they're prisoners. They're prisoners of culture. They're prisoners of culture and false beliefs, right? So like when you work in the finance world, you got your federal licenses and you're just taught, indoctrinated to believe certain things like risk and return are conserved is number one, right? So that for every incremental increase in return that you pursue, you are tied inevitably to an incremental increase in associated risk. That's true in efficient markets. It's not true in private markets. They don't know this. They don't even believe it. It doesn't even enter their sphere of consideration. The second issue that the second false belief is that market risk cannot be diversified away, meaning that if the stock market crashes, then everything's going to be affected, and there's nothing you can do about that, which is not true. You get out the fucking stock market, right? But the licensing of traditional financial firms is focused on trading publicly traded assets, and that's it. So that's their entire world. Risk and return are tied, conserved, inescapable, and market risk is a wave that you cannot escape. And the irony is that this is the highest credentialed industry in the world, the most academically oriented industry in the world. And you've got a bunch of idiots running around parroting the same bullshit with, Ivy League MBAs. Like, it's not obvious. Like, you can escape market risk if you go into a different market.
Well, a lot of them, like Jeff, hate it too, right? But they just can't do anything about it because the bureaucracy of the whole thing, like you said, the culture of the whole thing doesn't allow that. You got to get 60 approvals to use the restaurant, right?
That's true. Yeah. So, like, for example, even FINRA, which is a self-regulating organization, SRO, it's just the big wirehouses forming a cabal to govern the industry. I mean, that's literally what it is. It's a self-regulating organization. It's the big firms coming together and saying, we're going to make the rules that govern ourselves. Well, what do you think that's going to look like? What do you think those rules are going to look like? Those rules are going to be in place to keep their position and fuck everybody else, right? And so that's what you get. So don't underestimate the influence of corruption, but the result is what it is. And a lot of well-meaning middle management personalities just eat that shit up like it's gospel, right? So anyway,
go
ahead.
Well, last thing I'll say on that is, and I'm surprised I haven't said this yet, because normally I'll say it like 80 times on one of these calls, but to me, that's what I love about what you do, and it's always been my mission statement personally as well on the real estate and investment side in general, is we know the end result of how that works in the Wall Street culture and the big bank culture, to where it sets it up. There's a select few, the ultra wealthy elites or the big hedge funds, get all of the upside. And if they mess up, like they often do, they get bailed out and the little guy gets screwed. With what you do and what I try to do from a promotional standpoint is take this knowledge, take that opportunity, back to what we were talking about earlier, to everyday individuals like the people on this call. And I know we have some heavy hitters on this call as well, but nobody else, Warren Buffett's not on this call. So we're all looking to better ourselves as investors and as human beings in our financial future. And to me, that's the biggest mission statement, in my opinion, of what you do, is you give opportunities to individuals that previously were unseen, were unheard of, like, the GP stakes that we did last year that you talked about, or things that you'd never normally hear about that are commonplace for Goldman Sachs or Morgan Stanley. Now an individual like myself gets to participate in it. And so that's pretty fantastic, in my humble opinion.
Yeah. And so, like, I'd like to think I'm a good guy. I am very driven by like a strong sense of justice. But the reason I do things the way I do them is not just because I'm a good guy. It's because the industry and the market has been conditioned to make decisions based upon brand name. Like Goldman, and Jeff will tell you this, Goldman will fuck you. They'll smile and you'll still do business with them because their name's Goldman. They're going to fuck you and you're going to do business with them because they're Goldman, right? It's Stockholm syndrome. And so Adagio can't compete with Goldman and Morgan Stanley on brand name. So we've got to compete on merit. The good news is that because they've got such a huge corner on the market and can get away with fucking people, that leaves us a great deal of opportunity to take like good solutions and bring it to the market. So like, that's how we compete. I can't compete with brand name, but I can compete with substance. I can bring better financial products and services to the market. And it's not because I'm smarter than those guys, even though I am smarter than their frontline guys. I'd say I'm on par with their back-end guys, but the difference is their back-end guys are used to serve their adversarial motives, where I use the same expertise to create a better product and service for my clients and investors. So yes, I'm a good guy. I'm driven by a strong sense of justice, but it's just good fucking business.
Sure.
Go
ahead. Go ahead. I just realized we're an hour and 10 minutes in, so I should shut up and let people. And Joseph Compton, I just want to say, and I'm going to call on you later, Joseph. You better stay on. but he said LOL on Goldman, and he agrees 100%. So anyhow,
Yeah.
the crowd is with you.
So I haven't talked about Adagio ABL strategy in a long time. I'm talking about in at least a while, right? And I don't talk about it deliberately because like we're not just a real estate firm and people have a hard time wrapping their mind around that. But I did think it was a good time to bring up and discuss the Adagio ABL strategy because it is a perfectly hedged strategy against every eventuality, inflation or deflation, recession. So we did that and we talked about it. And the intent of this call was to be a dialogue. And I've run effectively an hour monologue, or at least a dialogue with Stephan.
It's my fault because I keep asking questions. But yeah, no, everybody, just a reminder, please, and I appreciate. Well, what do you think? I mean, should I bug Joseph right now, Ben, or do you want to continue with the slides and then dive in on a full Q&A?
Well, I would like to know if anybody like has any questions or criticisms or complaints about the thing that the ideas that I put forward. I mean, I'm offensive to some people, right? Other people, sort of are cheerleaders. So I'm just curious to get the perspective of the people who are in attendance.
Well, let's bug some people here. If you guys, no, okay, Joe, I won't bug you. He said he doesn't want me to call on him, but then Jeff just said every Goldman. Well, here, let me bug Jeff here. If I can figure out how to do that. I haven't used Zoom in a while, guys. So let me see if I can unmute Jeff. Jeff, how are you doing, my friend?
Pretty good, guys. How are you doing?
Good. Other than my constant coughing here, I'm doing pretty well.
Yeah, I heard that. Sorry about that.
No, it's just getting better every day. Jeff, just while we're waiting for people to type in some more questions and kind of engage a bit here, just to introduce Jeff, for those that don't know, you're an active investor, partner within the Adagio infrastructure, and you and I are partners together well on a couple of ventures. So having worked in the financial sector that we were just talking about and worked at Goldman Sachs with your background, can you give us a rundown of your view of what we're talking about and what made it appealing for you to kind of want to leave that infrastructure and come over to some of the things that Ben has developed with Adagio?
Right. Yeah, no, that's a good question. Yeah, it's from the Goldman network. I mean, it's definitely the the old boys club basically, and a lot of the bigwigs that are not going to let you participate in their fund. They're going to keep you out as much as they can. I kind of joke a little bit, about the Masters of the Universe comment a while back. I forgot who exactly was the one where they stole that quote from, but they definitely acted like that, when you work there. I mean, they would fly. I worked in Goldman in their Tokyo office for 5 years. I was in the Paris office for 3 years, and then Dallas as well. And in Tokyo, the managing director would fly in from New York for the week and attend some of the meetings, bless some of the deals, and fly out. And then later, after the IPOs closed or whatever the merger is that we were doing, he gets his $40 million bonus that year.
Wow.
So
I'd like to sign up for that. Well, and so I mean, it's kind of obvious, but just to double down on what you're saying, Jeff, I mean, how does that level of oversight and that culture compare with what you've experienced with Ben's infrastructure and Adagio's infrastructure as an investment bank?
Sure. Well, I think I've said this before too, but just in the 1 year, working together with Ben, and probably it was only even 6 months in, but I probably learned more from him about this industry than I did in my entire 10-year career at Goldman. They just opening up the, pulling the curtain back and really understanding how, everything works, all the mechanics of it, getting to learn while, having the opportunity to participate. That's what was really appealing to work with Ben and yourself.
Good deal, my friend. Well, thank you for being on and everything you do. And I need some more questions with you guys here. I need more engagement from. Oh, I think we got a couple coming in here. Okay. Joseph says he loves the approach. Appreciate you, Joseph. I'm going to call on you, Troy, because you were our first question today, and love to hear just kind of your insight, Troy. If you don't mind, you can unmute yourself. I'm going to send you a link to do that. If you don't mind, Troy, and I apologize for putting you on the spot, but like I said, you had the guts and the gumption to be the first question of the day. Could you tell us kind of your background, what made you come to the call, and kind of what your thoughts are on what you've heard from Ben so far and the market status as a whole? It says you're still self-muted there. I'm not giving up on you, Troy. But well, let me. I'm just going to start bugging people because I need you guys. We need you guys, honestly. Because we're all stronger and more engaged. And go ahead, Ben.
I'll jump in with kind of a specific question.
Sure.
Of the people in attendance, I'm just curious how they feel about their positioning against what may come in the future. I think we all kind of agree that there is an expectation of something substantial happening, whether it is a recession or further inflation. You got to think people showed up for a reason. What's that reason? Like, why are you here? What do you want to learn or hear or express or do? Right?
Great question.
If that question
Great
makes
point.
sense. Yeah.
No, that's great. And honestly, just my 2 cents to answer. I personally think it's, to me, undeniable that we're already in. I think when we look back on it, we're going to say the recession started in the spring of 2022. I think it's already happening and been happening. And to me, that's undeniable. But to reiterate, guys, so type in the chat box. I promise I won't call on you if you don't want me to, but to be on camera or anything like that. But type in the chat box, guys. How protected do you feel about your financial future right now? And honestly, if you feel like giving more detail, what steps have you taken to protect yourself or to capitalize on what you believe is coming? And or if you can type in the chat box, what made you come to the call today? That would be extraordinary as well. Joseph,
while they're typing in,
I won't call on you, but get it in there, Joseph. Go ahead, Ben. Sorry.
I'm just going to continue just to talk about some of the things that we've done,
sure,
and how to take some of the things that we did back in 2008 and how they're even more robust now. So I mentioned we talked about the ABL strategy as a pure strategy, but what we did in the last several months is created a fund.
Oh, Ben, I lost audio on you. I don't know if it's on my side or.
Stephan, I can still hear you. I can't hear Ben.
Okay. Guys, I think we're working with Ben's audio here, but I do see some questions coming in, so I appreciate that. So let's see here. So Joseph said, I'm here to focus on Ben doing things in the industry the right way. So it can't. Oh, it looks like we lost Ben there. I know that he's hard to get on these calls, and he actually is traveling today, and so there might be some Wi-Fi issues there. So in the meantime, I do thank you guys for the questions coming in. Leon said, how do you use swaps in the ABL strategy? So that's a great question that Ben will be excited about. I don't know the answer to. I'm going to unmute my buddy Jeff here. It's a good thing that you're on the call here, Jeff, because now we can ramble a little bit together at least. Good, Cal. We got a question from Cal as well. How do I use this info to become my own bank and create capital? I have a thought on that. Jeff, you and I have done a lot of webinars together, so this is serendipitous that we're both here together and Ben fell off. But do you
Right.
Do you have an insight on Cal's question here of how to become his bank? Yeah.
I do. I mean, I just know where I've started, right? And, I started actually reading, Ben's book and taking his masterclass. That might sound like a bit of a cliche answer, but it's info packed, really. It's the Shadow Banker's Secrets. Reading through it's got a good background on an overview on monetary policy, history, and then goes into all the different ways that you can conquer the capital markets, which is kind of a journey that we're all on together.
Well said. And yeah, guys, that is that book that Jeff mentioned, Shadow Banker's Secrets. That is featured on Forbes right now as well, and it's kind of moving up the charts there. There is some access. Anybody that has interest in getting access to that book that's on this call, I know we can get you a pretty significant discount off what's selling on Amazon. So please type that in the chat box as well if you want to get access to that content. Or I know we both, Jeff, went through the master class as well as helpful on that. And I'll just say my 2 cents. Ben touched on this with the ABL strategy earlier, the asset-based lending approach. And I do have a little insight on that because in my career as a real estate investor, I did do some hard money loans around the same time that Ben did. And ironically, I didn't know this until about 2 weeks ago when we had a discussion about the ABL strategy, when Ben told me he was doing sale leasebacks, which is exactly the same format that I use, which what that means is when you go to do a hard money loan, private money loan on a property, instead of lending to where you're putting a lien on that property that can be paid back, and then if they don't pay you, you have to foreclose, he would actually purchase the property, so he owns it, and then lease it back to the borrower. So let's say you own a home that's worth $1 million for round numbers, and you're looking to borrow $400,000. Instead of giving you a loan for the $400,000 in a first lien position, he would actually buy the property from you for $400,000, then lease it back to you with a master lease. And that way, if you don't pay, he doesn't have the expense and the time and the hassle of the foreclosure because he already owns the property. The same thing I did, and it's an extraordinary strategy. And from a lending perspective, there's a lot of loopholes that even I know on the real estate side, and Ben knows light years ahead of me, that can protect yourself and amplify your profits there as well. We do have a comment here from Ermias. Hope I'm pronouncing that right, my friend. He said, first of thanks for taking the time to put this together. I'm here to learn your services, learn your approach, and ways to leverage the chaos. Well said, Ermias. Really appreciate you putting it like that. And looks like Ben is back.
I'm back.
Ben, are you with me? Welcome back.
I am. Can you hear me?
Yes,
Yeah,
sir.
my Zoom just said "fuck you" and quit. Like it just shut down. So
it does that. It does that. Jeff and I could tell you about that, right, Jeff? I mean, we've had everybody.
That's right.
You kind of get the the battle scars with Zoom, but
yeah,
we had a couple of questions. Well, we had a couple of good questions. Yes, sir. Yeah. So, and Jeff and I both gave our opinion on it. We were talking about the value of the book and the masterclass for this, but Cal asked, how do I use this info to become my own bank and create capital? And Jeff touched on the value of the book and the masterclass, and I just was talking a little bit about what you implemented with sale leasebacks with the ABL strategy. But can you talk on that from an even more in-depth perspective for Cal and others?
Yeah. So that's a big topic. I mean, that is the reason I wrote
kind
the
of
book.
It's the whole book.
I mean,
right? Yeah.
Writing a book is not fun. It took years. There's a reason I did it because it's a question that everybody or a lot of people ask, and it can't be answered in a soundbite. But I can begin to address it from 30,000 feet. So if you're familiar with, at least vaguely familiar with monetary policy and how the Fed creates money. So basically, the government needs to borrow money, it issues treasuries, and the Fed buys those. Buys them with what? Just a ledger, right? They'll just effectively create a balance of US dollars that they create a thin air, and they give those dollars to the US in exchange for the paper, the debt. And then that money gets into circulation. It's multiplied through fractional reserve banking for the commercial banking system. And it's multiplied, again, by debt. So when you borrow for a car, for a house, you give the bank an asset, and that's your note. And in exchange for that note, they can put that note in their balance sheet. And it's an asset for them. It's a liability for you. It's an asset for them. It's incoming cash. They can offset that with a liability, and that's the dollars they create and give you in exchange. But they're created backed by your promise to pay, by the mortgage. So every dollar we've got is created as a function of debt. And so the next question becomes, well, what makes a bank special? Why can they do it and I can't? Well, fiat laws help. But in short, banks are perceived as responsible stewards and conservative stewards of money. And they, when they are given the prerogative to create and monetize capital effectively, it's because it's trusted they can manage risk. Well, you can do the same thing analogously with securities. As a matter of fact, securities are a type of money, M3, I believe. And so the analogy is this: the bank has this note that's, say that the government has a note that they just create out of thin air, or sorry, that they write, and then they sell it to the Federal Reserve effectively, because the Federal Reserve believes that they're low risk and they're going to pay. They're going to get the money back with the interest. And so for you can do the same thing, and you can do it through a fund effectively. So what you do is you create a fund, and then you basically sell the shares in that fund for dollars. So the capital you create is creating the fund, and you monetize it by selling the shares in it. So the sale of the interest, the shares in the fund, is the monetization of that capital. And so the next question becomes, well, shit, you got to sell it. Well, everybody's got to sell it, or even banks have to sell it, quote unquote. So how do you do that? What gives a fund value? And what gives a fund value is the verified, demonstrable, objective, risk-adjusted performance of the underlying strategy. So now the fund is really just legalese. It's a translation of a strategy into a document that's legally allowed to be sold. So if you have a strategy of your own, or access to someone else's that has competitive risk-adjusted performance, now you can wrap that in a fund. That fund now has value as a function of the capacity and the risk-adjusted performance of the underlying strategy. And you can sell that paper for the corresponding value of the underlying strategy. And so that may sound a little convoluted, but that's where it starts. So you're basically monetizing paper.
No,
Go
that's
ahead.
great. I'm glad
Steph?
you got back on, because that's a significantly more detailed answer than we gave. So that's good. Excuse me. I shouldn't laugh.
Okay.
I apologize. But gosh darn, I apologize. We did have one other question, Ben, that came in here from.
I can answer
Leon.
that better, but I mean that's why I wrote the book on it, right? So. Yep.
No, I think it's fantastic. I mean, and honestly, I think the big caveat, I'll just add this, Cal. Number one, and you might have already taken the master class or read the book, because I know a lot of people on this call have. If you haven't, that's a great place to start. If you have, and you have interest in kind of diving in deeper on that, and correct me if I'm wrong, Ben, but I would say the next step there would probably be scheduling a one-on-one call with you or myself to discuss further some of the options there and see how you can actually implement this for your personal situation. Would you say that would be the logical next step if he already has taken that step on the book?
Yeah, if you've already completed the book and or masterclass, then do what it suggests and schedule a call. Yeah, then Cal, I remember you, Cal. Yeah, schedule another call and we'll talk about it.
I thought Cal's name,
because everybody has. Yeah, so the idea is that everybody has a unique set of circumstances, resources, skills, values, interests, right? And so you can you can pursue a facet of capital creation that is conducive to who you are, right? And then delegate the rest. So, for example, if you're good at relationship building or marketing, you can become a capital aggregator and then delegate the strategy. Or if you have a strategy, but don't have the marketing skills, relationship to raise money, then you can delegate that. Very few people have both under one roof. But anyway, yeah, that's helpful.
Well, we're kind of a good example of that here, really, with myself and others. Anyhow, so Leon also asked Ben, and I don't know the answer to this, so I'm glad you got back on. So Leon said, how did you use swaps in your ABL strategy?
Didn't.
All right, that's a good quick answer.
So
Leon, okay.
Swaps. I mean, basically what a swap is, you're effectively swapping fixed income for equity or growth, right? And so if you've got and swaps are relatively common in the commercial real estate space. I don't use them, but I'm certainly aware that opportunities can exist too. So the way you'd play a swap is if you've got some fixed income that comes from something, you own a bond or whatever, right? And somebody else has net operating income coming from a property. You can swap that NOI for your bond yield. Why would you do that? You do it if you think that the NOI is going to stay above your bond yield. And the guy who's got that real estate would swap the NOI for the bond yield because he thinks the real estate NOI is going to fall, right? Mm-hmm. And you can do some financial magic with swaps that actually boost the yield on both sides in a kind of magically looking way. I'm not going to go into that, but I've never used them. I've always had an eye out for opportunities to use them, but I never really have. But I've seen a lot of colleagues use them really, really well and effectively. Now it's probably not the best time for swaps.
No, well, yeah, I think because everything's going. Well, Ben, can you go back to, because I have a question for you. Can you go back to the performance slide?
Mm-hmm. Sure.
And guys, and Jeff, and probably a lot of, and I think Cal, I thought your name sounded familiar. I think you've been on a couple of other calls we've had too. Everybody who has in the last probably, 6 to 8 months knows this is my favorite slide. And I always joke with everybody, with Ben, that this is really the only slide you need. And this thing should be blown up on a billboard because it's just so impressive to me. So my question, Ben, is when I look back at this and I look at how you deny, we talked a lot about what's happening now. But when I look at the different periods and I think about what was going on in the market at those times, to me, I would use the word, it's a blessing that in the last 15 years, and I don't know if this has ever happened before. I know it certainly hasn't in my lifetime, but it's incredible that you've really got everything under the sun just since 2007 to 2021 to compare to. You've got a horrific crash, the likes of maybe which we've never seen, or certainly among the worst. You've got an incredible recovery. You've actually, and you can correct me if I'm wrong on this, but my stat as a real estate guy, I think normally the cycles of appreciation in real estate go about 6-7 years. And we had, a decade of appreciation, which I don't think we've ever seen before in our country's history. So talk about how fortunate it is and what value that adds, that not only are you doing the risk-adjusted performance and you're putting everything through the analytics to see how it performs, but you're doing it at a time in history where you've got everything under the sun, including, I didn't even mention, a freaking pandemic to compare it to. So talk to me about the value that adds, the diversity you've seen in the last 15 years.
Yeah. So, well, to start, for us and for anybody who wants to meaningfully evaluate the quality of any strategy or investment or portfolio or otherwise, you have to look at a complete market cycle of data to have any, again, meaningful output. I can't tell you how many hedge fund guys come to me with 4 years of data. I'm like, what the fuck is this going to tell me, right? Like, how'd you do in '08? Oh, we don't have data that goes that far. Then we need to go, figure out what that would look like. So for me, it's really, I'd say, an issue of convenience, because I can look at 15 years of data and see just about everything, right? So if I say we're in 2006, that'd be a lot harder. You have to go back a lot further to get a full market cycle of the full range of market dynamics that was seen in 15. So for me, I mean, I don't know if it sounds cynical, but it's really an issue of convenience. And I'll tell you, like, as bad as 2008 was, what this annual data doesn't show is that Q1 2020 was worse for equities than 2008 was. We had some guys who passed 2008. I wouldn't say with flying colors, but they did relatively well across 2008. They did not do as well in February 2020. So, and again, the interval of the data you analyze needs to correspond to the liquidity or the lockup of the asset you're analyzing. So here, I've got S&P data shown annually because we're looking at a longer lockup, a 48-month lockup strategy here. So we can look at annual data. If we're looking at a hedge fund that's got monthly liquidity, then you have to analyze monthly data. So in the monthly analysis we do for hedge fund guys, that comes out. But yeah, so it's really the convenience. But beyond convenience, for me, with respect to someone who is looking at this with an analytical eye, I guess it's also convenience, because we have encapsulated we've covered the boundary conditions of history effectively in one 15-year cycle. The only thing excepting is the inflationary period of the 70s. But I've seen the 70s. We've modeled for that. We've seen what that market was like, and we've utilized that reference times a factor of 2 plus to.
That was probably your start, I would imagine. In 05, 06, you probably used that in the beginning. I don't know that to be certain, but I'd imagine.
I didn't know shit about finance in 2005, believe it or not. Right. So when I started my ABL strategy, I had learned real estate as of 2005, 2006, but I didn't know anything about finance. I intuitively knew that hard money lenders, as a source as a sink of investment, as someone who's raising capital, a hard money lender, I knew that they would do way better with an investor's money than the stock market would. But I didn't know how to communicate that in a credible way. So actually, my sister lived in New York at the time. She was actually dating Carl at the time, and that's how I met him. And everyone except Carl was condescending as shit, because I went up there like humble and hat in hand. I was meek and curious, and I was like, "Look, I know I've got a really good thing here on the real estate side. I don't know anything about finance, but I know that this is good. And I know that you have the wherewithal to translate it. So let's work together." And they were condescending and dismissive. And that made me fucking angry. Like, who I am first and foremost is an athlete, and I'm competitive as shit. So what I immediately did is I said, that shit's not going to happen again. So that's when I walked away and determined that I'm going to know more about finance than these motherfuckers know. And that's when I dove into all the CFA manuals. I got the Series 65, which is relatively trivial to the CFA stuff, and really dove into quantitative finance stuff, which really isn't even covered rigorously in the CFA. And ironically, I went back, and the same crowd was dismissive for different reasons because they didn't understand what I was saying anymore. No, I didn't know anything about the markets and finance at that time, but I did know math, right? And I didn't understand interpolation, right? Interpolation is when you have data points and then you construct an equation that fits the data. So, and it provides some guidance in terms of what to expect in the future. So that's what I'd done. I knew that I knew epistemology is a field of philosophy. I had taken philosophy in college. I knew mathematics. In part, it is physics. Like physics is applied math. So a lot of people are dismissive of a university education. For me, it was really valuable. I used like the comprehensive knowledge that I acquired in university and applied it to my business. So epistemology is the study of how do you know what you know, and you know what you know by looking at the past. So I looked at the past real estate data. So that's what it was, a philosophy class that drove me to look at historical real estate data. And then I saw the trends, and I used my math skills to interpolate that. But this was not finance knowledge, right? This was just like knowing some sort of general academic knowledge.
You know what I'm about to say, probably, right, Ben? Because this is something that we harped on a lot in the podcast that we did together. And again, guys, I got that link in the chat box. I recommend anybody that has interest, go ahead and watch that. But for those, you utilized what I would call a level of common sense, that you would develop the common sense because of your foundation of knowledge that you built in your studies. And those who don't know, Ben was a professional baseball player, went to school at LSU, and went on to be a pro ball player for a few years before diving in fully into this sector. But to use the sports analogy, Ben, it's kind of like that young team, that gets to the World Series and they're all in their early 20s, and people say, they're too stupid not to know that they shouldn't be there, because they just keep winning, and they're like, well, why can't we do this? Nobody's told them 100 times they can't, so they do it. And to me, from what I'm hearing, it sounds like you built up your knowledge base. You're obviously incredibly intelligent. You had the fundamentals that you learned, and you weren't held back by the things that you didn't know back in 07, 08, to where you were able to have success just on your core common sense and core principles. Now it's even better because you not only still have those fundamentals, but you also have the track record and the experience that you didn't have back then, and the additional 15 years of research and knowledge base to be able to hopefully excel at an even higher level. Am I off base and rambling at you on that?
No, that's right. I think what I think the most valuable sort of skill that I take away from my sort of finance journey is quantitative risk analytics. Because what I didn't know in 2007 that I know now is that I don't have to ask people what's better, what's not. Like, I can fucking measure anything, and I know how everything compares in demonstrable, accurate terms. And so I am not subject to bullshit. And I'm also able to help people who do not want to be bullshitted, right? Before that, when I went to New York, I knew, again, that hard money lending was good, but I didn't know how to communicate that in rigorous financial terms. Well, that's what risk engineering and quantitative finance is. So, yeah, it's a variation of saying the ability to wear the right clothes to the party and to make merit-based decisions that are independent of any industry-specific culture, real estate or finance. Because real estate's got its own fucked up culture.
I could talk about that. And Cal, you read my mind. Cal just posted a question. He said, "Can you post a link to schedule a call?" And
absolutely
I'm
not.
Right now. And
I am not a whore.
No,
I'm just kidding.
no. Well, get out of here, guys. You're taking it.
Yeah.
No, actually, I think what I'm going to do, and maybe not for Cal. I know you've talked with Cal before, it sounds like, so maybe you can take Cal directly if he wants. But what I'm going to do, guys, I'm going to post a link to my Calendly, which you kind of jumped the gun on me a little bit there, Cal, because my next and really one of my last questions for today for you, Ben, is so we've talked for almost 2 hours here on what's going on in the market. We talked about how to prepare for it. We talked about the success you had in a similar situation and really everything under the sun. Like I said, I personally, the research I've done and my personal belief on it, I don't think we've ever seen a more volatile, both, good and bad market cycle than what we've seen the last decade plus. And we're going into another core part for it now. So we talked about that and how they can protect themselves. If I'm on this call and I'm an investor and I've got, 400 grand in my IRA, or I've got 200 grand in the stock market, whatever it is, and I'm scared and I want to protect myself and be able to be confident about what's coming, what would the steps be for me to actually invest in this specific strategy and this performance that we see up on the screen? What would the next steps be on that?
Well, if you got 400 grand, you wouldn't talk to me about that. I'd say call Stephan. But the
Yeah.
in all seriousness, we've effectively wrapped the ABL strategy under our income-driven private equity fund, which utilizes a GP stakes structure to capture the best of both worlds. I'm not going to dive into the mechanics here. We can talk about that on a call. I've also got a case study that discusses how GP structures work. But long story short is we've got a fund that allows the members, the partners, to participate in the management structure of the strategy. So whether it's our ABL strategy or another private equity strategy or otherwise that we underwrite, they can, again, participate in the management, which is really low risk because the compensation is derived from the management compensation, which is partly a management fee. That management fee gets paid no matter what. Even it gets paid just upon the number of dollars and that have been raised effectively and how well that's preserved and grows. And then there's a bonus, the performance fee that gets paid on the strategy itself. So I'm not going to go and get into all the specifics because I feel like I've rambled a lot about stuff that people don't necessarily want to respond to. So long story short, it captures the best of all worlds. So this AIDPE fund, again, utilizes the GP stake structure to participate in strategies like the Adagio ABL fund, RIA roll-ups, and other, again, strategies that have been underwritten to, again, be hedged against the potential inflationary environment with the potential market crash without having to predict. And as a matter of fact, when you completed your application to access this call, on the landing page was a link to the full deck that contemplates that fund, right? So that's not what this here is, this deck. This deck is just to talk about sort of the general ideas. But the full deck on this fund, if you want to do what we're doing, is available on that landing page. And if you lost access to it or didn't download it or whatever, you can let us know in the chat box, and then we can get you a copy of that. And then you can schedule a call.
Wonderful. Fantastic, guys. Well, and I did post that, Cal. Again, I'll leave that up to Ben and see how you want to do that. But anyone that has interest in partnering with us or utilizing this strategy or simply discussing some options to protect yourself in your financial future, you've got that link to book a call with me. Then I can kind of assess your personal situation, let you know the general philosophies that I've invested in, that Jeff and others, believe in, that Ben has built. And then if it's something that you need to talk with Ben about, then I could connect you there if it makes sense to do so. What Ben meant when he said if you got 400,000 and you wanted to invest, you'd be talking to me instead of him, is to invest directly in Ben's fund. It's a $1 million minimum. So even me knowing Ben for 7-8 years and wanting to participate, I wasn't able to because I didn't have $1 million cash to invest in this, but I still wanted to be a part of it. So if you're in that spot, then you can invest in kind of a feeder entity or an investment club like what Jeff, who's on this call, has set up with me as well. And then you can invest smaller amounts and still be able to participate. And then we, as an investment group or club or feeder fund, depending on the structure of what we're talking about, we can still participate, invest as one together and share in that upside. So highly recommend at least exploring that. If you're somebody that is an active investor, if you're in the stock market, if you're in real estate, whatever it may be, and you're concerned about where the country's going, where the financial markets are going, you want to make sure that you've explored every possible option. Highly recommend hopping on that call, having that discussion, and see how we can apply it to you personally. So, Ben, as we close out the discussion, go ahead.
I was going to say that for some reason I'm having a hard time pulling things up, but I was going to add the link for my calendar as well for anybody who's on the what I call quasi-institutional side, or a qualified purchaser. So if you aggregate capital, if you're a fund-of-funds manager, want to be a fund-of-funds manager, if you can aggregate larger sums, then I will provide you access to my calendar to schedule a call where you or your group, with your financial advisor or otherwise, can participate directly. I'm pulling my calendar up right now.
Well, and that's
so
great,
I'll put that in the chat box shortly.
Perfect. And while Ben's doing that, guys, again, as we kind of close today's discussion, I want to thank all of you for being on the call today. I know it's scary times for everybody, but I hope that you're more informed than you were at the start. I hope that, like I said at the very beginning of today's discussion, I hope that you can leave with a sense of comfort and excitement to some extent that not only with proper planning and execution can things be okay in a time like this, but you can actually profit to a higher level than you can in any other market cycle. And that's not only my opinion, that's statistical, factual data that you've seen has been proven with the numbers and the stats and the performance that we've discussed and shown today with this specific strategy and implementing it on your own or with us as well. So as we close, Ben, what's your final thoughts for anybody on this call moving forward in the coming months?
So I did put my calendar link in the chat. So that's now available. Going forward, first of all, crypto, as I've been preaching for a long time, is a fool's errand.
You have. Yeah.
So
you got me on that.
Beyond that, you cannot predict the future. Nobody can. Don't try. The best advice that I can ever give is to prepare for every eventuality by looking backwards in time and seeing what has performed well. What did well in the 70s? What did well in 2008, 2009? And then taking the best from those experiences and synthesizing them into a plan moving forward. That's the case. It's only a distraction to have conversations about what the future may hold. That's just there's no value in that. The value is in looking back historically and, again, taking the best from what was seen from potential experiences that we may have. Again, inflation 1970s, crash 2008.
Pandemic 2020.
That's it.
Yeah. All right. Well, Ben, thank you so much for doing this. I know you're on the road today too, and I know that it's hard to get you on one of these calls. So it was a special time. It is a special time in the world, in my opinion, and I really appreciate you taking the time to chat with us. Jeff, appreciate you being on as well. And everybody who's on this call, thank you for taking the time to spend a couple hours with us here today. I hope we added value just either in discussing your specific financial future or plan or investing in this strategy that we discussed. Please book a call with either Ben or myself, and we're happy to see what we can do together. Thanks so much, guys.
Thank you, Stephan. Take care.